You've probably heard that governments print money, but here's the truth: they don't. At least, not the way most people think. So who actually controls the money in your wallet? And who decides how much money exists in the economy? Let's break it down. When people say printing money, they usually picture a machine printing paper bills. And yes, that happens. But that's only a tiny part of the story. Most money today isn't physical, it's digital. In fact, over 90% of all money in the world exists only as numbers in bank accounts. No paper, no coins, just data. So when we talk about printing money, we're really talking about creating money, both physical and digital. Here's where it gets interesting. Every country has a central bank. This is the institution that controls the money supply. In the United States, it's called the Federal Reserve, or the Fed. In India, it's the Reserve Bank of India, or RBI. In Europe, it's the European Central Bank. In the UK, it's the Bank of England. The central bank is like the manager of a country's money system. It decides how much money should exist. It sets important rules. And yes, it controls the creation of new money. But here's the key point: the central bank is not the same as the government. This confuses a lot of people. The government runs the country. It collects taxes. It spends money on roads, schools, hospitals, and defense. The central bank manages the currency. It controls inflation. It tries to keep the economy stable. In most countries, the central bank operates independently from the government. Why? Because if politicians could print money whenever they wanted, they might print too much. This leads to inflation, where prices rise and money loses value. History has shown us what happens when governments print unlimited money. Countries like Zimbabwe and Venezuela experienced hyperinflation. Their currencies became almost worthless. So central banks exist to prevent that. They make decisions based on economics, not politics. All right, let's talk about actual printing. The central bank decides how much physical cash is needed. Then it orders the printing, but the central bank doesn't run the printing machines itself. In the US, the Bureau of Engraving and Printing produces the bills. The US Mint makes the coins. In India, the RBI orders currency from government-owned printing presses. These bills are printed with special paper, watermarks, and security features to prevent counterfeiting. Once printed, the cash is sent to banks. Banks distribute it to ATMs and their branches. That's how it reaches your wallet. But remember, physical cash is only about 10% of all money. The real story is digital money. This is where most people get confused. Digital money isn't printed. It's created electronically. Here's how it works. Let's say the economy is slowing down. People aren't spending. Businesses aren't investing. The central bank wants to increase the money supply to encourage spending. So it uses something called open market operations. The central bank buys government bonds from commercial banks. When it buys these bonds, it pays the banks. But here's the key: it doesn't use existing money. It creates new money digitally and adds it to the bank's accounts. Just like that, new money exists. The banks now have more money. They can lend more to businesses and individuals. This increases the total money supply in the economy. No printing press needed, just computer entries. This is called quantitative easing when done on a large scale. The central bank has another powerful tool: interest rates. Let me explain with a simple example. Imagine you want to start a small business. You need a loan from a bank. If the central bank sets low interest rates, your bank can borrow money cheaply from the central bank. So your bank offers you a loan at a lower rate, say 5%. You take the loan, you start your business, money flows into the economy. Now imagine the opposite. The central bank raises interest rates. Your bank now has to pay more to borrow money, so it charges you 10% for your loan. You think twice. Maybe you don't take the loan. Less money flows into the economy. High interest rates slow down money creation. Low interest rates speed it up. This is how central banks control the money supply without printing a single bill. Let's look at a real example. During the 2008 financial crisis, the U.S. economy was collapsing. Banks were failing. People were losing jobs. The Federal Reserve dropped interest rates to nearly zero. It also bought trillions of dollars in government bonds. This created massive amounts of new digital money. The goal was to keep money flowing through the economy and prevent a complete collapse. It worked. The economy slowly recovered. But there was a side effect. All that new money contributed to rising asset prices. Stocks went up. Real estate went up. This is why central banks have to be very careful. Too little money can cause a recession. Too much money can cause inflation or asset bubbles. It's a delicate balance. Here's something most people don't know. Commercial banks, the ones on your street, also create money. How? Through something called fractional reserve banking. When you deposit $100 in a bank, the bank doesn't keep all of it in a vault. It keeps a small fraction, maybe $10, as a reserve. It lends out the other $90. The person who borrows that $90 spends it. That money gets deposited in another bank. That bank lends out $81 of it. This cycle continues. From your original $100, the banking system has now created much more money in the economy. So money creation doesn't just happen at the central bank. It happens throughout the banking system. The central bank sets the rules, but commercial banks play a big role too. So, to answer the original question, who prints money and who controls it? Physical printing is done by government agencies, but it's ordered by the central bank. Digital money is created by the central bank through bond purchases and interest rate policies. And commercial banks multiply that money through lending. It's a system designed to keep the economy stable and growing. Subscribe.